Hey everyone! Today, I'm diving into one of the most influential entities in the US economy, the Federal Reserve System. This powerhouse was born out of necessity in 1913, thanks to the Federal Reserve Act, signed by President Woodrow Wilson. So, what exactly does the Fed do? First off, the Federal Reserve, or simply the Fed, serves as the central banking authority of the United States. Think of it as the backbone of the financial system, ensuring stability and growth. It acts as the fiscal agent for the US government, safeguards the reserve accounts of commercial banks, and manages the nation's money supply. The Federal Reserve's creation was a response to recurring financial panics. Remember the early 1900s? The economy was a roller coaster, and folks were desperate for a more stable and flexible monetary system. The solution? The Federal Reserve, to provide an elastic currency and a safety net for banks. Now, let's talk structure. The Fed has a unique setup. It balances centralized authority with regional representation. At the top, we have the Board of Governors, appointed by the President and confirmed by the Senate. These 7 members oversee the entire system. Then, there are 12 regional Federal Reserve banks scattered across the country. They offer insights into local economic conditions and implement monetary policy decisions. Speaking of monetary policy, that's where the Federal Open Market Committee, or FOMC, comes into play. The FOMC is the star player in formulating monetary policy, aiming for price stability and maximum sustainable employment. This committee includes the 7 board governors, the president of the New York Federal Reserve Bank, and a rotating selection of 4 other Reserve Bank presidents. Through open market operations, like buying and selling government securities, the FOMC influences short-term interest rates and credit availability. But the Fed's role doesn't stop there. After the 2008 financial crisis, the Consumer Financial Protection Bureau, CFPB, was established within the Fed. This independent bureau is all about protecting consumers from unfair financial practices. They write and enforce rules for financial products like mortgages, credit cards, and student loans. Let's dive into the Fed's tools. One key instrument is the reserve requirement, which dictates the percentage of deposits banks must hold in reserve. By adjusting this requirement, the Fed can control how much money banks have available to lend. Another tool is the discount rate, the interest rate at which commercial banks can borrow directly from the Fed. Lower discount rates encourage borrowing and economic activity. Higher rates can help curb inflation. Open market operations are another crucial method. When the Fed buys government securities, it injects money into the banking system, potentially lowering interest rates. Selling securities does the opposite, withdrawing money from circulation and potentially raising rates. These operations help the Fed maintain stable prices and promote sustainable economic growth. So, next time you hear about the Fed, you'll know it's not just a faceless entity. It's a well-oiled machine working behind the scenes to keep our economy running smoothly. Thanks for tuning in. True Real History.